What's up everyone, it's Scotty with Money Investing. So in this video, we are going to be talking about liquidity, right? So we focus very much on liquidity on this channel, trying to understand, okay, where is the actual liquidity coming out of and where it's going? Because at the end of the day, that's what actually drives market, right? Liquidity meaning big money, big capital, and the flow of funds. Having that understanding is really going to help us identify opportunities moving forward and of course, get rid of opportunities that are no longer working. So hope you guys are doing great. And as always, if you enjoy these videos, find them helpful, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, we're trying to get to 75,000 subscribers, so make sure that you subscribe. The link to our Discord and Patreon is going to be down below if you're interested in joining us and of course getting access to all the buy and sell alerts, options alerts, trade ideas, investing alerts, and of course a lot of private videos and lectures and tutorials as well. So a very simple question, and as Silicon Valley Bank failed, I pretty much had that presentation. I showed you guys a very simple question was, where is the liquidity, right? Where is it actually going? And in that video, we talked about there's a couple different places, right? Number one is the actual Treasury Department, right? So US Treasuries and fixed income. Because it's considered to be safe, it is more risk-free in nature, right? So if companies are taking money out of Silicon Valley banks, they are sticking it into either US Treasuries or sticking it with some of the larger banks, SIPs. Now, speaking of, that will most likely continue, and the reason is because, of course, Janet Yellen, the Secretary of the Treasury Department, says something absolutely crazy. We talked about it during our live stream. I want to play that clip here for just a minute. We're going to listen in and then I'll share my thoughts, right? So just listen in and I'm just going to play it. I also played it during my live stream, but, wanted to do a video about this and kind of share my thoughts. But let me just play this and then we'll kind of talk about it. So here we go.
Don't have time. I need to be able to drill in on a couple of things. Let me start with some of the banking issues we're dealing with on it. Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVB just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So right there, that's a simple statement, which is pretty much saying that the uninsured deposits of a failed bank, the only way they're going to be made whole or they're going to be actually protected is if the FDIC, supermajority of the FDIC board, the Fed board, and Janet Yellen in consultation with the president determine that those uninsured deposits actually can create some systemic risk in the system. If that's not the case, if it's a smaller bank that we're talking about, guess what? It's not going to be insured, which we'll get into here in just a minute.
Is your plan
that determination?
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening
And
because you're
it's-
fully insured no matter what the amount is if you're in a big bank. You're not fully insured if you're in a community bank.
Well, you're not fully insured. And
You were at Signature, and it just barely met that threshold. You were at Signature.
well,
I know.
All right. So there was an ad. But the bottom line is that it is absolutely crazy to believe that some banks, even in the regional sector, in the medium, small size market of banking and financial institutions, some of them uninsured deposits are going to be safe, some of them are not. And the problem with this is that over time, I think there's going to be a lot of consolidation within the industry where everyone's going to move deposits out of the smaller banks, medium banks, and the regional banks and over to GSIBs, which are, again, systemically important banks, right? I literally talked about this in one of my videos where systemically important banks will have the support, the full support of the United States government. That's why some of the bigger banks are able to benefit off of this liquidity crisis because they're raking in a lot of deposits, right? Bank of America taking in $15 billion of deposits, Citigroup, Wells Fargo taking in billions of dollars of deposits as well, is one of the places where the liquidity is going to. But I wanted to talk a little bit about something else as well. In other words, where are some of the other places where liquidity is going to? And I've broken it down into 4 categories. The first one is fixed income, so US Treasuries, and that's I'll show you with some facts and some charts and some analysis here. But fixed income is number 1. So US Treasuries absolutely are seeing a lot of inflows in liquidity because yields are coming down. That's a clear signal, and we've also seen an inflow in bond price ETFs. Big tech is another one. In fact, Daniel Ives today mentioned how big tech is a hiding spot for investors in the market right now. It is relatively safe, right? I'm not written down as that safe because it's equities. It's definitely got a lot of risk carrying for it, but it's relatively safe considered to some of the other sectors out there. Semiconductors are another sector where liquidity is flocking to. It is risky. It is certainly not a safe sector to be in, but it's got the cash. A lot of companies, NVIDIA, AMD, Qualcomm, a lot of companies that have actually done well in the last week or month or so have a ton of cash on their balance sheet with a lot of less debt. So they are obviously considered as relatively safer compared to some of the other sectors out there. And commodities, especially gold, has seemed to be outperforming pretty well. And again, it's considered to be relatively safer. And all the concerns around the currency and the fiat currency that we've had, gold being more of a physical commodity and something that has actual store of value, has also seen a substantial move, and gold prices have actually been pushing higher. So these are the 4 places where I strongly believe, and there's data to back this up, where the liquidity is going to. And Daniel Ives, in terms of big tech, pretty much mentioned that we believe many generalist investors that were hiding out in financial stocks and the overall banking sector are now seeing a much more white knuckle environment, not knowing what news will come out on a Sunday night and which bank is under distress. While it sounds like a quote twilight zone comment to many investors, tech stocks have become a new safety trade, with big tech names a major beneficiary of this dynamic. Investors appreciate that profitable tech companies have limited exposure to the financial sector, have an immense war chest of cash, and benefit from the fast-growing secular trends like artificial intelligence. Many cautious investors traditionally viewed bank stocks as safe havens in times of uncertainty because of their relatively cheap valuations, while tech stocks were seen as a risky bet due to their higher valuations. This has completely flipped over the last 1 week. If you come over to the last 1 week here, take a look at liquidity here. It's straight, very, very obvious. Financials and energy, liquidity coming out and going towards big tech. We got Microsoft up 12% this week. Apple's up 4%, Google's up 12.5% this week, Meta's up almost 9%, Amazon is up 9%, and Tesla's up 3.86%. And we also had NVIDIA up 12%, AMD's up over 18%. So very, very clear understanding where the money is going to. And it's not only all tech, right? If you take a look at IT, some of the more smaller companies are still struggling. If you take a look at Applied Materials, Lam Research, and Clack Corporation, all 3 I've actually covered on the channel, talked about them before. Quality companies, great balance sheets, great growth, great fundamentals. They're the ones seeing a lot of momentum, and not so much some of the other companies in the tech sector that might be trading at a little bit of a higher valuation, may not have the best balance sheet, so to speak. This right here is the last 1 month, I believe. And if you take a look at what this liquidity shift has been, almost all sectors are red except for Google, Meta, NVIDIA, AMD, Microsoft, and Apple's pretty flat, right? Amazon is slightly down 2%, and Tesla has obviously been selling off quite a bit for its own reasons, but the liquidity shift has been pretty enormous. If you move forward to another chart, this is going to be another time frame. I forgot what it was, but the bottom line is you're seeing a lot of concentration, a lot of green in the top left of the market, and the money coming out of the bottom right of this heat map, right? So we got healthcare, energy, materials, utilities, and financials, all these sectors. We're seeing a lot of outflows, and it's all going towards big tech. And that's one of the reasons why the markets have started to do a little bit better. I mean, this past week, the Nasdaq's up 4.4%. In fact, we've seen 11 straight days of Nasdaq's outperformance relative to the S&P and the Dow, simply because of this liquidity shift. This is ETFs. And you can see where ETFs money's coming out of and where it's going. You can see fixed income over here, absolutely green. TMF, for example, is up 4.2%. This is today. And you got commodities, right? Gold prices, silver, everything pushing higher. So in the ETF sector, we've got commodities, we've got fixed income. And we've got, of course, the inverse ETFs because they moved inversely to the price of the index that they're tracking. This is going to be another time analysis, another energy and financials being the worst performers and selling off. And we're seeing a lot of momentum back up into fixed income, commodity, and of course, some of the other US global large cap stocks as well. So bottom line is that just because the markets are pushing higher doesn't necessarily mean that it is actually a beginning of a bull market and it's like now for us to start to go push back higher. But instead, I'm just kind of showing you the analysis that's backing the idea that investors that were hiding out in financials or energy or some of the other sectors are rotating out. We're actually rotating out of these sectors over to technology, commodities, and fixed income as we kind of battle through this uncertainty. It's possible that we see a big rotation once again out of tech, out of commodities, out of fixed income, back into energy and financials if and when things start to kind of settle down, the dust settles. But just wanted to kind of break this down for you. I'm in big tech. I'm in fixed income. I'm not in commodities. I've got a very, very little gold. So obviously that's benefiting us and our community here. But I just wanted to kind of break down a lot of the liquidity that's driving back and forth and the rotations that we're seeing within the markets. In my opinion, I think everything that comes out from a more macroeconomic standpoint is what's going to drive the market. And we're probably going to be in a very much of a sideways price action where we continue to trade back and forth between the bulls and the bears. We're constantly seeing a lot of indecision in the markets. At least that's what I believe the markets are going to trade and how they're actually going to trade over the next few weeks to a few months until the macroeconomics are more settled and much better in terms of where we think we're potentially headed moving forward. But I do expect a lot of sideways action and a lot of rotation in and out of different sectors as investors once again look for areas in the markets where the opportunity is. But let me know in the comment section down below, what do you think about the liquidity that we're seeing flow into fixed income, flow into commodities, and of course big tech as well. Big tech being the big beneficiary is kind of catapulting the markets entirely pushing higher. On the week, S&P, Nasdaq, they're all higher. But we got to be careful and understand what's the main reason as to why the markets are pushing higher in the first place. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining us. As always, happy investing. I'll see you all in the next video.